Hi guys, William here, and welcome to This Week in Crypto. So in episode 2 of This Week in Crypto, I'm just going to be going through what I'm looking at this week and my personal take on the market and whether or not I'm constructive on the market as a whole. I'm also going to talk a little bit about liquid staking with Ethereum and one option that allows you to become a validator with less than 32 Ethereum. I'm also going to talk about some random stuff at the end that has to do with Chainlink and Avalanche that I found interesting, so stick around for that as well. All right, so let's jump right in. So the only important date this week really is Wednesday. Everybody's going to be waiting for Wednesday to happen. I imagine that Monday and Tuesday and trading going into the FOMC meeting on Wednesday will be pretty volatile. You can expect a 75 basis point rate hike. That's personally what I'm expecting. That's what the consensus is expecting. However, after the bad CPI print that we got last week, there was the appearance of this 100 base point probability, and all probability for a 50 base point rate hike went out the window. And that's why we kind of saw the markets reprice, because the market doesn't like uncertainty. The market hedges uncertainty. And so the appearance of this 100 basis point rate hike was not good for price action. So that being said, I think that the 75 basis point rate hike is baked into the market. So if we go to the 2-year yield, we can actually see what the market is anticipating. So right now the 2-year yield is around 3.67. We'll see how that opens tomorrow. So 3.67 on the 2-year yield. It's a little bit higher than the 100 basis point rate hike. Typically what the market does is the 2-year yield prices a little bit higher than what the highest expected rate hike is. So if we do get a 75 basis point rate hike, and that would put the target rate at 300 to 325 basis points, we would expect the 2-year yield to actually come down a little bit off that. And so I would imagine that since the market has a little bit of this 100 basis point rate hike priced in already as of last week, we would actually get some relief in the markets if we do get 75 basis points. So that's really the only important date this week that I'm aware of. So now I'm just going to hop into the markets and why I am cautiously bullish here. Now, in my very first video, I laid out why I was bullish. I still remain bullish, but I kind of want to go through why I am bullish right now in the markets. And that's based on one thing, and that is the 10-year yield. Now, why is it important to watch the 10-year yield? Well, the bond market controls every single market in the world. It is the largest market, hundreds of trillions of dollars if you include derivatives, and it is orders of magnitude larger than the stock market or any other market in the world. And so stability in the debt market or instability in the debt market or large sell-offs or rallies in the debt market have a direct effect on what is happening in other markets like crypto and equities. On top of that, bonds are how central banks around the world rig their monetary policy. They can't just speak an interest rate into existence. They can't just go, oh, the overnight rate is now 3%. Okay, so everybody just obey that. No, they actually have to get in there. They have to sell or buy securities to influence the yields and interest rates. I'm here on the 10-year yield, and I just want to show you guys something quite interesting that I was looking at. So I'm on the monthly now, and this goes all the way back to 1981. But I want you to notice the slope of these channels, I guess you would call them, as we've progressed through time. The slopes of these have gotten increasingly more steep, right? That just means that the bond market has become increasingly more unstable as time has gone on. And that's because every time we hit a recession, the Fed has to ramp up its monetary policy or its quantitative easing as of 2008 to get us out of that in order to bring things back to a more stable level to where the economy is thriving again. And the thing about fiat systems is that over time, they just get more and more chaotic until they break. You can see that literally in this chart. It just gets more and more chaotic, and eventually it's gonna break. Now, personally, I think that the bond market is actually on the cusp, the brink of breaking with everything going on and the amount of volatility that we're seeing in the bond market. And that's why risk assets have really sold off a bunch during 2022. Because if the bond market isn't stable, if you can't even feel safe in bonds, then why in the world are you going to buy stocks or crypto? So that's kind of what we've been seeing. Now there was, at the beginning of the pandemic crash, there was a large increase in bond yields, which means that a lot of money was flowing out of bonds. But since this was a risk-on environment, a lot of that money coming out of bonds, it didn't go into the dollar. It went straight into equities and crypto. But when inflation started spiking, we had continued increase in rates and it's gotten really volatile. And so we've seen bonds sell off and that money going straight into the dollar. You know, if you look at my Twitter banner on Twitter, let me actually go to that real quick. I made this the other day. I'm actually quite proud of it. It's from one of my favorite movies is Lord of the Rings. And I don't really want to talk about the new show, so don't talk to me about that. It's watchable. Nothing beats the movies. Anyways, what you can see here is you have Gandalf leading his army from, where was that from? The army of Rohan. I don't want to nerd out, but you have them and they're coming in and they're flanking the enemy troops here. Anyways, I put on here yields up, risk assets up. Yields up, risk assets down. Right now, we're in this environment. This would be the risk off environment right here. This would be the risk on environment. When risk is on, as bonds sell off, that money flows straight into risky assets. When we're in a risk off environment, the correlation switches. So it's not just the same correlation no matter what. A lot of people think that bond yields up are always negative for risk on assets, but that's not true because in the past we've seen like here at the beginning of 2020 and 2021, you can see that an increase in bond yields here correlated with a massive influx of money into the crypto market. So going back to this, right now we're in this environment right here. We're going to remain in this environment indefinitely until it becomes risk on again, which could be a long time. Now, additionally, there's the dollar here in the background because the king dollar, he's kind of behind the scenes there, kind of ruling it all because when the dollar is king, like we're seeing now, when the dollar is outperforming every single currency and asset in the world, we're having all this exodus of money out of bonds and risk assets and is going straight into the dollar. And that's because our government's tightening a lot more than other governments are. Let's go back to the 10-year yield. We've gotten increasingly more volatile as time has gone on because the more money you print, the more debt that you have, the more dramatic that your monetary policy has to be. And monetary policy is a direct result of, or I should say that bond yields are a direct result of what monetary policy your central bank is trying to enforce. One thing I wanted to note is these orange boxes here. Whenever we have a massive increase in bond yields, if you take the overall range, so this would kind of be like the overall range for this period of time, you have an overperformance of that range at first, and then it drops down and kind of consolidates before a bigger leg down. So we have this overperformance at first, then it drops down, stabilizes, and then we have a massive amount of money flowing into the bond market, which is noted by a decrease in these yields. Same thing here. We have, if this is our period of time here, we have this range. We overperform at first before dropping down into a lower range. And then after we consolidate in a lower range, we have a big influx of money into the bond market. So going here to our next channel for this time period, we have a overperformance in bond yields. Then we come back down, we consolidate, and then a massive amount of money flows into the bond market. Same thing, overperformance, consolidate, a lot of money coming in. Overperformance, consolidate, a lot of money coming in, so on and so forth. As you can see, it gets steeper and steeper. But look what we had recently before the COVID pandemic. We had a lot of money flowing into the bond market. We overperformed in this range, and then we fell back down into this bottom range, and then we had a massive sell-off as money was seeking bonds during the pandemic because everybody was risk off. You know, money can flow into a few places, right? It can flow into commodities, it can flow into the dollar itself, it can flow into risk off assets like bonds, or risk on assets like equities and crypto. So there's like those different pools of money. Where is value going to be transferred? Right now, the value is going straight into the dollar and out of these other assets. So what do we have here? Well, we have this major overperformance. We came back down and we're overperforming again in our little range here. Well, it's not little. And we're now reaching the top of this zone. And this is actually almost a decade long channel that we have, or this trend line resistance that we've already found resistance in once. I'm going to go to the the daily. We've already found resistance here once before, back here when bonds peaked and we had this decrease in bonds and then everything rallied, equities and crypto rallied. This means that the market is anticipating lower inflation and a temporary top in rate hikes. And if you want to know more about that, go to my first video and watch that. I explain all about that, everything you need to know about the dynamic there. So knowing our current environment of this, yields up, risk assets down, we've seen a massive sell-off in risk assets again. They've been selling off due to this massive increase. I mean, look at all this money coming out of bonds right here. This is crazy. So in white, I have here a double top. We need to watch bond yields this week to see how they react to what the Fed is doing. If bond yields come down and they peak here on Wednesday's rate hike, that will be a good thing. And that's personally what I think is going to happen and why I am cautiously bullish. All that means is that I'm bullish, but I have 15% stablecoins, or I have a certain percentage of stablecoins. Personally, for me, that's 15%. Now we have an overlap between this double top area and this longer term resistance channel from before that we've peaked at twice. The way that the market works right now is if yields peak and we come down, I believe that we will see things rally again. With the way that quantitative easing and quantitative tightening work, I believe that we're tightening more than other countries. And that's represented here. You can actually go and look at interest rates of other countries. And our interest rate is higher than every other country except for Canada. So the basket of assets, the basket of currencies that are within the DCAing, the largest one, 56%, is the euro. And the European Central Bank just started raising interest rates like a couple months ago. They just started hiking rates on the 6th of June. We've been hiking rates since February, right? So our quantitative tightening has had a long time to have an effect on our currency. However, ECB is weighted 56% to the DCAing, and since quantitative tightening strengthens your currency, they haven't even really had time to feel this strengthening effect that increasing rates have on their currency yet, which is why the DCAing has gotten so strong. The second biggest weighting in the DCAing is the Japanese yen, and they haven't even started hiking rates yet. So their currency is just getting destroyed. They really can't hike rates at all because they have so much debt. And I'm gonna make a video about that later, about how it's hard to hike rates when you have a lot of debt. Their debt to GDP ratio is the highest in the world, which is why they're paying out negative interest rates. So pretty crazy when you're paying out negative interest rates. Like having negative oil like we had in 2020, where oil companies were literally paying people to buy their oil. So that all just goes to show that basically we're breaking the rest of the world by raising our rates. And at some point we're gonna have to stop and allow these countries to raise rates themselves, because as we raise our own rates, it crushes other people's currencies. It messes with imports and exports, the way that countries are able to produce goods and industry. So we're really crushing all these, world countries right now with the amount of tightening that we're doing. So it's really important, on a world scene, the Fed's going to have to weigh, the risks of crushing other countries. And maybe they'll say, okay, we're going to slow down monetary policy and I'll let these other countries tighten. If they do that, then the DCAing, or the relative strength of the dollar, will decrease, and our bond yields will also peak if they do that. Going back to interest rates and the bond yields, I think that bond yields are close to peaking. If they're not close to peaking, then I'll basically flip bearish. The only thing that would flip me bearish right now is if we saw something like this, and we just see like massive increases in bond yields blowing past like this resistance and everything. Also, we have this RSI. It's in this upper range. So, I'm bullish based on the fact that it's more likely that the DCAing starts to weaken and the bond yields start to come down at some point in the close future. So basically, I think we're close to the DCAing peaking, which is enough for me to be bullish, to start accumulating, because you don't want to start accumulating when everything turns around. You want to start accumulating when you think we're close to having a trend change. You want to anticipate the narrative, anticipate the trend change. So I'm bullish because I'm anticipating peaking bond yields some point in the close future, as well as the DCAing, even though I think that the DCAing particularly can go to like 120. It definitely could. And it potentially has more upside. However, I think that would be the peak. And so I'm gonna accumulate on the way to that. I'm not gonna wait for the charts to tell me, okay, it's now is the time to buy, because at that point, the money's already been made. So that's kind of the way that I look at the market personally. So that's why I am bullish. The first reason why I am cautiously bullish, I should say. Remember, cautiously bullish, I have 15% stable coins. So I'm not like 100% in on these markets. I wanna jump into total cryptocurrency market cap. Something interesting that I don't know, I haven't seen anybody talk about this, but maybe it's a thing. So just something that I've noticed. So when you have total cryptocurrency market cap, you'll notice that after a large run up in price, you'll have this kind of consolidation area before the next run up. Then it kind of consolidates. You have our next run up. Then it consolidates, and then, well, you don't always have a pandemic, but in this case, you had a pandemic. If we didn't have the pandemic, we would have kept consolidating here, I believe. And then you have the next run up, and then at some point, we're going to consolidate. And could we be consolidating in our range right now? Absolutely. Could we drop another 30 or 40%? Absolutely. So I kind of want to go through the lowest level I can see total cryptocurrency market cap drop and kind of give a range and give why I think that. So here in pink, these pink lines, you can see that during the downtrend, we typically like to hug the downtrend the whole way down. We kind of disconnect from it pretty steeply at first, and we rally, and then we establish a trend, and then we kind of hug that for quite a while. You can see that back in the after the 2012 bull market, which that was 2013 bull market. I definitely wasn't around then. I mean, I was born, but I wasn't around for this bull market in crypto. And so here we were, we had a decoupling from this trend line. Then we kind of hugged it for a while, and then we decoupled from it again, and then we consolidated. Eventually we broke back above it, and we went to this little nice bear market rally that we had. And so here you can see that we hugged it for a while, and then now we've kind of decoupled from it, and now we're hugging it again. I anticipate that we are going to remain pretty close to this trend line until it's time to go into a bull market. Now, the thing that I was looking at was, it's interesting that if we go from the bottom to the top of a bull market, we tend to, at most, with our limited amount of history that we have here, we tend to consolidate around 50% of our move up. So for example, at the beginning, we had a 1,509% increase in total cryptocurrency market cap, approximately, back in 2013. And we consolidated, we basically retraced 50% of that. In real terms, that's a 75% drop, the way that the math works. But if you measure it from the increase, you can see that right in the middle there where this arrow is, we exactly consolidated 50% of our move to the upside. So if we take where we consolidated then and we go to the next move higher, you can see that we didn't even consolidate 50% of our parabolic move up. Let's zoom in here to this little bull market rally. So we consolidated in this little area right here. I'm just gonna pick a random spot, and you can see that we consolidated again at that 50% spot. We consolidated at half our move up, basically. And then we would have continued to do that, I think, but then the pandemic hit, and then so we kind of broke that. So we can kind of build a range off of that, I think. I think it's kind of cool. So let's build this range here, and then we can see, if you go from our bull market or our bear market lows during this time, a 50% consolidation or decrease puts us at around 539 billion in market cap, in total cryptocurrency market cap. So that can be kind of our starting point. So then we can extrapolate other starting points off. So maybe we can take the pandemic low, and then we can get a second level here. So this would be maybe our second point, maybe a likely point of consolidation. And then we can get a third point. So if we actually do want to use this bear market consolidation, because again, if we didn't have the pandemic, we would have had a nice long period of consolidation here probably, if not an earlier takeoff, because as you can see, we took off earlier, and then the pandemic hit and we went way down. So if we use this level of consolidation, our next point would be this $755 billion range. And the interesting thing is that we already touched that $755 range, or we almost did. This first area of consolidation, if we take our move from this consolidative area all the way up, a 50% drawdown, or if we retrace 50% of our move up, that is basically where we bottomed. This is a scam wick right here. Don't mind this wick. This is a bad print. But I remember, these wicks are legit, because I remember that's where total cryptocurrency market cap was during the Terra Luna event. Or the Terra Luna unwinding event. So we already basically touched that. And that's the other reason why I am cautiously bullish, is because I don't want to be bearish when I think the bottom is potentially in, right? It's very likely that the bottom could be in. So remember, this is an area of consolidation as well. So could we come back down and maybe do a double bottom? Absolutely. Could we kind of decouple from that trend line again and maybe find some support and start hugging it and then consolidate down in this area before coming back up? Absolutely. So maybe take a screenshot of this and then see if this is what actually happens. No, I'm just kidding. So I'm not going to be bearish right now because I think that the bottom is in or it's close to being in. And the time to be bearish was when we're printing all-time highs. That's the time to consider being bearish, not when we've already been selling off so much. A lot of people get that backwards, right? Typically, you should be building positions, bullish positions, during massive price drawdowns. Now, you can say, you kind of have to specify, because you can be bearish in the fact that you expect further negative price action, but then what are you doing during that time? Are you building positions? Because if you are you really bearish, or are you bullish long term and maybe bearish in the short term? Because it kind of depends on how you define it. So me personally, I am more bullish because I think that the bottom is in. Now, could we fall back down into this level, this 50% retracement level? Yes, that would be 20% down. If we fall down to this middle level and consolidate around there, that'd be around 31%. And then 43% would be the furthest down I could potentially seeing this bear market going before, we consolidate. So that maybe would look like something like this. Maybe we'd find support somewhere on there. We'd make a double bottom, and then we'd kind of consolidate in this area before taking off again into the 2024. I think is when the next Bitcoin halving is. So let's go ahead and move on to our next point here. Basically, you've probably seen this chart drawn many times in many different places, but we can take a look at our long-term trend line. This is a logarithmic view. So this linear line on a log view gives you exponential growth. So you get something like that, right? With a linear line. So let's zoom in here and kind of see where we're at. I kind of want to adjust this a little bit. I think that the COVID pandemic low was a definite point on the chart, because that was like max fear. Like no one knew what this virus was doing. So I think that's a very strong point of support. I think it should be utilized in trend lines. So this is what I would say the overall trend line looks like. Again, you've probably seen this many different places, but is the place to be bearish when we're here? So really think about that. Is the place to be bearish when we're on this long-term trend line? If it was easy to be bullish when it was the appropriate time to be bullish, everybody would be making money. It's so easy because of the sentiment in the market, to be bearish during these times. The time to be bearish is like here. Of course, in hindsight, that's like easy to note, to like tell when the right time to be bearish is. But like, if you know the right time to be bearish was up here, how can you have the same attitude when we're down here? You can't be bearish at the top and bearish at, after a 70% sell-off. Ask yourself, okay, in hindsight, where was the appropriate time to be bearish? Oh, it was at the top, obviously. That was where you would want to start, trimming positions and, accumulating some cash so that you can buy when you're bullish again. Well, if you're bearish right now, why in hindsight are you bearish here, but also right now? That doesn't make sense to me personally. I mean, everybody has their own way of looking at the market. That's kind of the way I think about it. So we're kind of here, man. We're here like at this trend line. Now is not the time to be bearish. Now, can you respect how the asset class behaves? Why did it do that? Can you respect how the asset class behaves during times of high inflation and rate hikes? Yeah, you can respect that risk on assets sell off during times like that. But you can be bullish in the fact that this is the time to build positions. On total cryptocurrency market cap, I have the easy bands pulled up. Remember, guys, if you made it this far, you're enjoying this content, what CryptoStackers has to bring you. So check out the link in the description below and go check out the CryptoStackers website and get these indicators for yourself, so you can actually, you can depend on yourself. Basically, you won't be dependent on someone else. You can make your own decisions based on these indicators. So one of these indicators are the easy bands, and you can see that the easy bands are pointed downwards, so we know the trend is negative. But we have this trend line that we've now established as being a trend line, because now we have more than 2 points. We built this third point right on this trend line. I guess you can say our third, we've had 3 points, but I would say that this is kind of like our first point. This one wasn't like a direct touch, and then that's our second point. So we had a potential trend line forming, and then now we have confirmed it as a trend line. So if you were looking to de-risk maybe, and you don't have a lot of stable coins, I would wait. This is not the time to de-risk, right? Because we're on support. And the time to de-risk and sell is not when we're on support, because look at here, we're on support. So the time to de-risk would be a retest of a strong resistance point. So a retest of this would be a good place to de-risk, right? You would be getting like potentially 6 to like 10% more from what you're selling, and potentially a lot more than that if you're in lower cap coins or even Ethereum or Avalanche or Solana. You're getting more out of your money if you need to de-risk. So now is not the time to de-risk. On Ethereum, in the CryptoStackers Discord, we were actually talking about how this was a really good place to de-risk. So on September 12th, I posted this in the CryptoStackers Discord. I also posted it on Twitter, but I said that I don't feel the need to de-risk here, but if you're low on stablecoins, this would be a great place to de-risk. And that's pretty much where we topped. So if I go back to our ETH chart, that's ETH dominance. That's where we topped. This is where I recommended people de-risk in the CryptoStackers Discord. So alpha like this gets dropped not only by me. I would say that I drop, relatively little amount of technical analysis alpha compared to a lot of other people in the Discord, like these other CryptoStackersticians here. Plus Gus C, he would be here as well, but he's not online. So they post way more technical analysis alpha than I do. I'm less of a technical analysis guy, more of kind of like a fundamental, big picture type of person. But I do my fair share of technical analysis. But you can see I gave my reasoning behind it. First of all, we had this 21-week simple moving average from our easy bands. That's really strong resistance. We failed it here. We failed it here, and then we were approaching it again. We also had this downtrend line that added to that resistance. We also had this now invalidated uptrend that was heading into that resistance as well. And then our margin pressure levels gave us resistance points at the same place. So this would have been a really good place to de-risk. Now is not the time to de-risk. That chance has already passed. If you de-risk here, you're potentially shooting yourself in the foot, right? Don't sell here. Let's go back to Ethereum. So yeah, we've established this downtrend line. If you're in Ethereum, but maybe you accumulated Ethereum like I did into the merge, but you don't want to sell your Ethereum right now because Ethereum is down. Obviously, why would you want to sell? So where I would sell, if I felt the need to de-risk or build a stablecoin position, I would do it on another additional retest of this trend line or this, which actually coincides with the 21-week simple moving average again. If we go to Ethereum dominance, I kind of just wanted to talk about how Ethereum is behaving. Ethereum is no longer behaving like an ICO or a super speculative asset where you have these massive, this massive volatility against Bitcoin. Right now, it's acting more like ultrasound money, which is what it is, with the merge being successful and everything. That's why they call it ultrasound.money. And that's why so many in the Ethereum community refer to Ethereum as ultrasound money. It's because it has properties that are necessary for something to actually be good money, like hard money. Compared to Bitcoin is more of a commodity type of cryptocurrency that has its advantages, but Ethereum is the ultrasound money. You can see that while in the past we've had massive speculation in Ethereum against Bitcoin, and just these massive moves, Ethereum has really transitioned into ultrasound money, in that it's kind of slowly grinding upwards, and it's no longer in this massive speculation phase. Like people recognize what Ethereum is and what it's capable of doing, and how there really isn't going to be an Ethereum killer, in my opinion. There's just going to be competitors. Obviously there's market share to be shared, but there's no real Ethereum killer. Ethereum is kind of rooted itself. And so it's behaving as such, right? It just has the slow grind upwards and an increase in market share. And so what we're seeing right now is we're finding support in this channel. And the next level to look at, because we did break below this this bullish trend line here that we followed for so long. Terra Luna happened and we broke below it, and then we were above it for quite a while, and we found resistance, and now we've come down quite a bit, broken the purple lines. We're now finding support on this green line. So again, another support zone for Ethereum. If you bought Ethereum into the merge and you're a little disappointed that Ethereum is now sold off, now is not really the time to sell your Ethereum, in my opinion, not financial advice. The next line to watch would be this white one. So I would expect and would hope that we would follow this trend line. If we don't, then we would most likely fall back down into this wider accumulation zone here. But that just goes to show that's why it's important to have stable coins. Even if you're bullish, you have to anticipate potentially being wrong, and you have to weigh the risks. I'm I have enough risk tolerance to say that I only want 15% stable coins. And so that's kind of my view on the market. Okay, so that's everything. Let me look at my notes here and see what's next, because I think that's everything I wanted to cover with charts specifically. So just to recap, if you are looking to de-risk, I think it's important to wait, right? You don't want to sell when your bags are down, right? You're just shooting yourself in the foot. And you know, if you do have low stablecoin accumulation, I wrote a Twitter thread about how even 2 hours a week doing something like DoorDash or Amazon Flex or Uber Eats, something where you're your own boss, you don't have anybody directly overseeing you, you don't have to work a specific amount of hours a week, you can literally work 0 hours a week if you wanted to, and they're not going to kick you off the app. You can literally only work 2 hours a week. That's 2 Netflix episodes. If you can sacrifice 2 Netflix episodes a week to build your cash position during a recession so you can deploy, that's how you're going to win. You have to grind. There's other ways that you can do that too. It doesn't have to be Uber Eats or DoorDash or Amazon Flex. I just gave those examples because it's super easy to sign up. I signed up in like 30 minutes, and then the next day on Amazon Flex, I was able to go get deliveries. You may feel like it's like looked down upon to do those things, but it's really not. Like in the end, who's laughing when you're the one doing these maybe like side hustle jobs and building up these cash positions and deploying them into the market? And if you want to, I do have a Twitter thread about that if you want to read it. But basically, if you give 2 hours a week, you can put $150 at a rate of $18 an hour, which is what Amazon Flex pays. You can get $150 per month in a cash position that you're yield farming or doing something with, building your cash position up. That way you don't have to feel like you have to sell your spot crypto for cash because you think it's going to go lower, because what if it doesn't? We've already come down so much. You don't want to take that risk with your spot portfolio. You want to find other ways to build cash. You want to get new money coming in so you have a positive cash flow, and then you want to deploy that capital at very specific points in time using the easy bands or margin pressure levels or something. But you don't want to be selling these levels of support as we've already been selling off. So the next thing I'm going to talk about is something that is quite relevant right now, and that is the Ethereum liquid staking. Now, if you don't know, the best way to earn yield on your Ethereum is to have 32 Ethereum and become a validator. So that's the minimum requirement to become a validator. It's kind of like your collateral, right? You're putting up enough money to where you say, okay, I'm taking this validator thing seriously. That way the other validators and the whole Ethereum network trusts you to take it seriously. Because if you have bad actors that are validators, the network is not going to survive. So that's kind of like their price limit, right? You have enough money on the table to where you're going to take it seriously. If you don't have 32 Ethereum, the way to earn yield on your Ethereum is to do these liquid staking protocols. And I mean, this has been around for a long time. Coinbase did it to where they allow you to deposit your ETH, and then they take all that Ethereum in groups of 32, and then they make like validator farms with it, and then they pay the yield out back to the people that stake with them, even though that Ethereum is locked and they can't get that back until later on next year when the Shanghai upgrade goes live on Ethereum, which is in 6 to 12 months. My cat's here again. Do you guys have problems with cats going on your tables and stuff? Because it kind of bothers me, because cats' like feet are probably not that clean. Anyways, so if you don't have 32 ETH, you're able to do it through Coinbase, and then they take a portion of that fee and make money off of you giving them your ETH. So you're not getting like the full percentage of what the 32 ETH is making as collateral for a validator. Then these liquid staking protocols opened up, which I'm sure you know about. I'm sure you've heard of Lido and Rocket Pool, and maybe you've heard of StakeWise. But there is this website that I found called simplestakers.info. It's made by a particular person, and I couldn't find his Twitter, so I would shout him out, but I don't know his Twitter. But he built like a series of dashboards here. You can go to different ones. But this one is simplestakers.info. It basically shows you the APY for all of like the good high liquidity staking pools, right? Because you don't want to send your precious ETH to a protocol that doesn't have high liquidity. So these are the different ones. So you have Anchor, Coinbase, Lido, StakeWise, and Rocket Pool. And you have your APYs here. And here in market price, you can see their discount to ETH. And the idea behind this is that because of the way the market works, the liquid staking market usually gives you a discount to the native asset, which is Ethereum. So they give you a discount to their derivative of ETH, like staked ETH or your Anchor ETH or your Coinbase Ethereum usually is issued at a discount because there is more risk involved, and no one knows exactly when the next upgrade will happen on Ethereum, which is the Shanghai upgrade, which actually allows you to swap between these derivatives and Ethereum one-to-one. So the idea is if you can buy, for example, with Anchor Protocol, you can buy Ethereum and get 4.95% more Ethereum for your money if you're willing to hold this Ethereum until the Shanghai upgrade goes live, because at that point in time, you'll be able to swap one for one. So you're getting kind of like a 5% instant yield on your Ethereum. And then while that is occurring, you also get this 3.32% APY. So with these combined, you get this other metric, which is called the effective APY, which not only takes into consideration the discount in the APY over a certain period of time, which is around here is 9 months. It also takes into consideration the fees that the protocol charges you in order for using their services. So a lot of people don't know this, but you get charged fees just straight out of your yield by doing this. And the yield that you get, like this percent yield over time, decreases as you get closer to the Shanghai upgrade, because basically the way that the rebase works and the way it rebalances, you get a lower APY as time goes on. So this APY is constantly decreasing as we get closer. But at the time of the Shanghai upgrade, you'll be able to swap one for one. So you'll be able to, if you get this 5%, you'll be able to redeem that extra 5% of Ethereum at that time. Now, the one that I was leaning more towards is Anchor Protocol, because it has a higher discount. Obviously, that means it's more risky, but it gives a pretty nice little discount. So if we take a closer look into these different protocols, you have Anchor Protocol, which actually has had a pretty big increase in the amount of Ethereum that's been delegated to it or staked with them. And the total value locked on Anchor with Ethereum is $76 million. So we've had that increase. We see a lot of people looking at that market price thing or that discount, and then moving to Anchor Protocol. Lido has actually had a interesting decrease in the amount of Ethereum staked with them. So they've had a decrease. I think as we get more competitors, this is kind of what we want, right? As we get more competitors, you get a more distributed Ethereum issuance to these different liquid staking protocols. Rocket Pool has seen probably the most adoption recently, at least, but we've had a drawback here again as people, ETH is kind of selling off right now. And then Stakewise also has come down a little bit. And this dashboard is DeFi Llama, and you can go and look at that. So the one that I'm more interested in is Anchor. So Anchor currently pays 4.31%. The interesting thing about Anchor Protocol, or the Anchor ETH, is you actually get it gives you more of a discount than what this is showing, unless this is changed. I'll check it right now so we can see. Okay, so let's go to Curve and look at the derivative, which is AETHB. And let's see what the exchange rate is. So we got one for 1.1063. So you're getting a 10% increase in your Ethereum. Now that's enough to be like, okay, why is it 10%? Is this what's wrong with this protocol? Why aren't more people taking advantage of this? So you have to be a little cautious when you're doing this. Right now, you're getting basically a 10% future yield on your Ethereum if you hold that Ethereum until the Shanghai upgrade, to where you'd be able to exchange that one for one. So it's something to think about. And while that's going on, you also earn that 4.1% that they pay you, which will decrease as you get closer and closer to the Shanghai upgrade happening. But it's definitely an option to think about. If you do decide to do a liquid staking option of one of these that are recommended, maybe only do a certain percentage, like maybe 50% or 70%, because you don't want to, if one of these protocols goes down, you might not be able to get access to your Ethereum. Now, the last opportunity that I'll show you is actually a way that you can become a validator without actually having to have 32 ETH. Now, this network is called Swell Network. And what they do is they allow you to stake right now, and eventually you'll be able to stake and vault, and then you'll have an ETH2 stake and vault. But basically what they do is it's like Lido, right? It's permissionless and non-custodial, but it allows you to become a node operator with a lower barrier of entry to 32 ETH. So it cuts that in half and makes it 16 ETH. And the way they do this is they allow you to put up 16 ETH as collateral, and then they broadcast your node. You sign up as a validator, you put in your IP information and all this different stuff, and you register as a validator. Other people who don't have 16 ETH but still want to earn some yield, they put up a minimum of 1 Ethereum, and then you, with your 16 and those minimum 16 other people, or I guess maximum 16 other people, when you're all pulled together, you have built this representation of 32 ETH, so you can become a validator. You, as the person who gave up the 16 ETH as collateral, has the say over that node, and the people that are putting up minimum of 1 Ethereum will have less of a say. That basically means they'll probably get less yield, or they will get less yield. So this is one way that you can do that. It's kind of cool. One thing I'll talk about really quick why I'm bullish on Ethereum is that even though Ethereum is seeing negative price action, it's actually seen an increase in the amount of value that it is settled. This only goes back to January of 20 this year. So Ethereum is settling higher amounts of transactions at the same time that Bitcoin is losing that market share, which I think is really interesting. You can show some other chains. And I think last week was a bullish time for XRP. So you can see that Ripple jumped up in its transaction volume, which is pretty cool. And then Bitcoin Cash is just dead. So let's go on to the next thing that I found is interesting. So Chainlink killed it last bear market, as I'm sure you've heard, and it underperformed during a bear market. So this is Link divided by Bitcoin. And as you can see, you kind of have this here early on when Chainlink launched, you kind of had this downtrend. And when it broke it, it just outperformed the rest of the market until the next bull market, and then it underperformed. Now we have something here that's quite similar. What we have is during the bull market, it underperformed on this trend line to Bitcoin, and now it's starting to overperform again during this bear market. So or outperform. So we're getting to this point where it has a chance to break through this downtrend line, and perhaps like how we did last time, where during a bull market it underperformed and then broke through during the bear market and outperformed. Chainlink could actually be outperform again in this bear market. And I think that'd be really interesting if that happens. I'm just keeping an eye on Chainlink. Obviously, you probably don't want to buy this resistance here. You probably want to wait on the other side for it. But this will be interesting to watch if Chainlink will have a repeat of what it did last time. All right, another thing I found was interesting is that I've seen numbers about Avalanche issuance being like 20% inflation. However, I came to this and I saw this 5.44% issuance rate. If you go to the high inflation, maybe I will pull that up real quick so you can see what I had in my mind as an inflation rate for Avalanche. All right, so if we search Avalanche, you can see that Avalanche has a 24% inflation rate. That's the number that I had in my mind, but surprised to see a 5.44%. So I was looking into it, and this is why it's actually less than you think. So Avalanche has an issuance rate that is meant to mimic or peak at the same time that Bitcoin's peaks. And this is an important thing to realize, is that 100% of the fees on Avalanche are burned. So every time that you pay a fee, it burns a fee. And I think that 2 million AVAX have been burned out of the current total supply, around 400 billion. So that's around like 0.5% of the supply that has been burned. The next important thing to realize about Avalanche is that 100% of what's minted, or 100% of the tokens that are emitted, go towards stakers. So if you have more stakers, if you have 100% of Avalanche staked, then you're going to have a higher inflation rate to meet those demands. Now, Avalanche is built. This is a cool part about Avalanche. The protocol is built to issue tokens to mimic Bitcoin's or to peak at the same time that Bitcoin's issuance peaks in like 2042, based on 100% of Avalanche being staked. However, the likelihood that 100% of the Avalanche supply is going to be staked is low. So what you get is a lower inflation rate than what you have in this red line, and you might get something like an average between the red and the blue. Basically, the more people that stake, the higher the interest rate is, or the higher the inflation is, because you have more tokens that you need to pay out. And so we can see how much of Ethereum, or how much AVAX is being staked right now. And this number actually really surprised me. 65% of the total supply right now is being staked. So that is a very high number. So the total supply right now, the max supply is 720 billion tokens. The total supply right now is around 410 billion. So we're over halfway to that mark, which is why the inflation rate seems high, because they still have to issue a lot more tokens. But the rate at which we get to that 720 million, that could take, look at the time scale on this. That could take 20 years from now, 40 years from now. before we get to that final the final level of emissions. So the way that that 5.44 number is calculated is you take how much is staked and you multiply that by the staking rewards. And this is where you get, like, if you take 65% of 8.94, you get pretty much almost exactly 5.44. I think you get 5.5 or 5.6%. 8.94% isn't going out on 100% of AVAX tokens. It's only going out on what's staked. So 65.36% of that. So that's how the AVAX inflation rate is calculated. If you're an AVAX person, then this is probably interesting to you. If you're not invested in AVAX, then you probably have already clicked off the video, but that's okay. I hope you guys enjoyed that. That ended up being a little bit longer than I anticipated, but again, I only release one video a week. So I think that these longer form videos will actually be beneficial because it gives you content that you can kind of just digest throughout the week. Again, if you want to check out CryptoStackers Pro, I'll put the link in the description below. And if you want to follow me on Twitter, I'll give you that link as well. And I'll link Forrest's videos and channel and YouTube in the description for you guys to go check him out if this is your first time coming across CryptoStackers. All right, guys, thanks for tuning in for this one. I'll see you next time. Bye.